Good afternoon, everyone. Before I start, let me give you a little bit of context on the alpha creating opportunities mantra. So whenever we say mantra, then we are also sort of highlighting the kind of discipline which the fund managers are maintaining on a daily basis, and that helps them to you could say contain the hygiene of the fund as well as generate portfolio returns and obviously reward investors who are already invested in the fund. And I'm sure a lot will go and subscribe to the fund once they hear what exactly they believe in, what exactly they are doing with respect to the fund. So let me start with Amit. Now, well, 5 years, Amit, and I think time flies by. I'm sure this is something which you can relate to as well. 26% CAGR. I mean, you have a lot of laurels on your part. How was the journey? Do explain us that.
So Kshitij, thank you so much. Thank you, PMS Bazaar, for inviting me. 5 years is actually just half a decade. The only thing which has changed is I've got white hair now. But when we started with banks going bankrupt. Then we saw, and we had out of 90 lakh crores of banking assets that time, we saw 7-8 lakh crores of banking assets in NPAs. 2019, you had just the credit freeze everywhere, and it was tough. And 2020, of course, we had COVID, wave 1, wave 2, wave 3. We saw negative crude oil in April 2020. We saw $120 crude oil. We saw 0% interest rates. We saw 5% interest rates. See, I'll tell you, but yet, great entrepreneurs are scaling. There are 1,700 companies which are listed on NSE. You need only 25 good ones. That is 1.5%. These entrepreneurs are scaling regardless, and you don't even have to be with the same entrepreneur all the time. जब तक जो scale कर रहा है, हम उनके साथ रहना है. And when they stop scaling, we move to a better opportunity, and that is what we have done. It's been great, we feel very happy that our clients have done very well in this. And a lot of volatility is always there, but a lot of opportunities are always there. Today also, I think we are 99% invested. So less money, more opportunities all the time.
That's great news, Amit. And as usual, you're candid about everything, which I'm sure everybody loves about you when it comes to speaking about your portfolio. Because when you speak it, you just pour your heart out, and that's what connects investors as well. The fund manager is already invested in the fund. Investors also get connected to the fund. So yes, kudos to you. But yes, we'll definitely come back and hear more about such stories, your investment styles, and etc. But let's move on to Gaurav as well. Gaurav, from your side, I mean, to set the perspective, if you can get some highlight on the investment style that you've been following.
I mean, to be fair, we don't have an investment style. We are very bottom up as a house. And I mean, we keep hearing about this value growth and different silos in which investors tend to put stocks into. But for us, it's really very simple. You got to start with a good company. That company, I think, as Amit said, should have scalability. But more importantly, it should be cash generative. It should be profitable. And then you ought to have good guys running that show, right? So good managements to back, and hopefully available at reasonable valuations. But I think for us, the most important aspect is that at SBI, we have access to a very large research team. We have 40 odd individuals on research, 20 of whom are on equity research. Right? There are some on fixed income and credit research, and some on lateral research like economics and ESG and quant and stuff. But 20 dedicated research analysts. And I think having access to one of the largest research teams in the country means that you don't necessarily have to boil yourself down to a particular investment style or a very quant-driven approach to investing, and which is why we usually tend to think in terms of a core satellite approach to investing.
Exactly.
Core essentially are ideas for us that we want to just stay invested in for the next 10, 15, 20 years.
Right.
These are companies in secular sectors run by good managements. So then you don't necessarily have to worry about macro cycles and this and growth, value, all of those things, right? But the other aspect is that because you have access to such a large research team who's always on the ground, who's talking to experts, who's talking to companies, who's talking to the entire ecosystem,
right,
you also sometimes get a whiff of a big cyclical change that's around the corner. And hopefully, sometimes you may get that before the rest of the market does. And we also don't want to lose focus on such opportunities. And which is where the satellite piece of our investing comes in, where we are always thinking of where is the change at margin, which is going to be so positive that it's going to get non-linear returns for us over the next 2 to 3 years. Again, these are not speculative bets. These are not ideas for the next 3-6 months. These are still 3 to 4 years ideas. But you're trying to sort of get a sense on a cyclical change that's happening either at the sector level, broader economy level, or at the company level, which if you get early in, not only do you get disproportionate earnings benefits, but also because you hopefully get in at decent valuations. So you also get a bit of valuation re-rating. So that's something that adds non-linearity to your overall portfolio. So that core satellite, core is what gives solidity. Yes. Satellite is hopefully what gives you a bit of non-linearity.
That's right. Now, Jigar, I think Gaurav also highlighted about the core and satellite strategy. 7 years, of the fund, 800 basis point alpha that you've created. How are market cycles impact fund performance, especially core and satellite? How do you want to delve into that?
Yes, Shruti, thank you for this. Thank you everyone for joining in as well. See, I think it starts with a thought. Mm-hmm. Right? That the quest for the holy grail for everybody is the same. Right? A company that can consistently grow earnings for an extended period, we are all looking out for such a business. The disconnect, however, is very vivid. A lot of people start believing that because earnings can compound consistently, share prices also do. In our estimation, that rarely, if at all, happens. Right? What typically happens is that having found such a great business, the market gets very excited and the share prices start getting dislocated vis-a-vis the fundamental earnings growth in the first leg of the cycle.
That's right. The P expansion that you're talking about.
Yes. But then eventually, right, share price and earnings growth has to add up, which necessitates the second leg where earnings sort of keep rising and share prices don't go anywhere. And people sometimes don't realize this can last 10, 15, 20 years, right? When Warren Buffett bought Coca-Cola in '88, it was for the next 10 years a wonderful investment, 10x in 10 years.
Right.
But then for the next 19 years, when the earnings doubled, stock returns were essentially zero, right? Same way, IBM, 1994 to 12 years, earnings tripled, stock returns zero. Colgate in India, 1994 to 2009, 15 years, earnings quadrupled, stock returns zero. So I think these cycles are present at the stock level, at the sector level. 14 to 19,
right.
All we could think about is consumption, right? Same way 2000 to 2008, all we could think about was capital goods. And now somehow that cycle is back again.
True.
In 2008, when the index peaked, the capital goods index took 11 years to come back to the same level. Right? So we are seeing these cycles essentially everywhere, stocks, sectors, market caps. Jan 18 to March 20, your large cap index was down 12%, small cap index was down 50%. Now the narrative that was created was, look, there are only these 20 great investment ideas in India. FIs will only invest here, domestics no, FIs will only invest here, so this is the be-all and end-all of investing. But then the cycle turned around and we are seeing basically what's transpiring. So I echo Gaurav's thought, cycles are there that needs to be sort of arraigned in the form of a good core versus a satellite approach. The definitions may vary in our case, but essentially the time where a good company stayed a great investment, I think in India are long gone.
Rightly put there. Sumit, we also, if you can start off with your investment style, and then I'll probably move on to more specific questions with regards to the fund.
And this is a hugely debated topic always. What's the style, right? And everybody will have their own style of investing. But we believe if anybody is coming to equities, it's actually growth, which is he coming for. Because if there is no growth, equity actually turns into a debt, right? So this growth can be of earnings, can be of capital efficiency, or over period it has to translate into what is the value creation.
Right.
So essentially we look for what is the secularity of this growth, right? Because without growth there is no life, right? And even so-called debate between growth and value, you start to see value coming into force only when there is growth into it. A value without a growth has no value. Right?
Exactly.
So essentially what we look for clearly is what is the long period growth that a business would deliver. In fact, not only visible growth, what matters actually is what is the terminal growth that the business actually can see. Whenever we start to question a terminal value, that is where all hell break loose. Right? So to that extent, there is a very mindful eye on the longevity and the terminal growth. Right?
Right.
And growth in isolation doesn't have too much of a meaning. A company which has a very poor capital efficiency, but growing very fast, actually can be a very bad combination because it requires support of externalities to really make sure that the growth that they are delivering actually creates into value. Right? And nobody can predict how markets would be at a point when they really need that capital. So if a company can fund its growth all by itself, that is what a value creating growth is. And in many cases, we really see that this value creating growth actually turns out to be higher than the growth itself. So fundamentally, what happens is the principles of investing don't change. It's just that businesses change in character. So as investors, we need to keep flocking towards businesses where we see this longevity of growth backed by capital efficiency, which derives or which actually then gets into value creation.
Right. Now, in fact, I'll just add on to this question, and probably this comes from retail investor side as well, and we also get some queries around it. When we see a rise in price, and earnings obviously will take time to catch up, as you already pointed out. There's a kind of a FOMO phenomena that happens. Everybody just talks about the story that they've been hearing about. How do investors sort of make that kind of right judgment call, you could say that?
This is pretty correct, that businesses which keep growing in earnings, at a point market believes that these are the only businesses which one should invest into.
Exactly.
So essentially what we have developed is an internal valuation metric which shows that what is the optical illusion price, right? So essentially what happens in markets is they start to project short-term higher growth into long period of time. Right?
Okay.
So markets always move in that extreme, right? When times are bad, they start to project this shorter term growth, shorter term challenges as if this will continue forever.
Okay.
Right? And vice versa as well. So if one start to plug in those higher rate of growth into a significantly longer period of time, then you start to get to some value, right?
Right.
Which markets start to ascribe. What is that value? That is where it start to make a difference, that here is the optical illusion price, wherein you should be lot more worried of the growth that market is imputing into, because markets are extrapolating this short period growth into longer term. That is where all the worry should start by.
So some of the sectors could be defense at this point in time?
I would still not say defense per se, because they're still not expensive from that perspective.
From that perspective. Okay.
We can see, so many of those businesses which are one-timers,
right,
which are more episodic, what matters is how long can you see into that cycle. Right. And that is where the whole difference of growth rates would actually come by.
Okay. So I will hold on to that thought and it will come back later then. Amit, you've talked about your experience last 5 years, but we never got to know the investment style. So, I'm sure our investors here would want to know about that as well.
So, broadly, when we speak about returns, a lot of people ask us, what has been your risk? Which is, so how do you calculate risk? And our portfolio beta has been 15% lower than BSE 500. Our returns have been 26% plus CAGR. Our alpha compounding has been 10% per year. our portfolio risk has been 15% lower than BSE 500 and 23% lower than Nifty 50. If you calculate beta as a measure of risk, the similar standards for standard deviation. Now, what do we do? What is our investment philosophy? India's nominal GDP growth is 14%. India's nominal GDP growth is 14%. 14% growth के नीचे अगर कोई भी company grow कर रही है, for us, it is not something that we are interested in. Unless the valuations were free, of course. But minimum growth that I need is 14%. Then, there are about 54 companies in India which are more than 1 lakh crore market cap. But there are between 50,000 to 1 lakh crore market cap, there are about 74 companies. This becomes a large cap basket. At Stallion, not even 1 month since inception, we have been less than 50% large caps. We've been 50% large caps, always. And our average small cap exposure is 10-15%. Coming to large caps. First, I spoke about about 1 lakh crore market cap plus there are 54 companies. Out of these 54 companies, Kshitij, Titan, Varun Beverages, Bajaj Finance and ICICI Bank, except these 4 companies, we don't expect more than 20% secular growth anywhere. In the 50,000 crore to 1 lakh crore market cap, there are 74 companies. There are companies like Polycab, which are growing at 30%, companies like Trent, which reported 50% growth. That is where, like Varun Beverages, of course, is now more than 1 lakh crore, but Indigo, today, Indigo, this year, analysts expect, today is the number, so I don't want to say too much. By the way, Zomato just came out with good numbers, like Indigo today is at 90,000 crores market cap. It is dominant monopoly, it is expected the profits of Indigo will be 8,000 crores. And market cap of Indigo today is 92,000 crores. It just tells, like, it is secularly growing at 18%. We've seen it in every crisis. This stock keeps coming back. The only risk, so you want in that large cap companies, you want to chase very decently high growth. If you buy, let's say this quarter, HUL came with 3% growth, ITC came with 4% growth. Kshitij, we cannot hold them. So that is the large cap portion. In small caps and emerging monopolies, I'll just finish this part. We're looking at market leaders who are scaling at 20, 30, 40%. How many small caps become mid caps or large caps? The last decade, it was Page Industry, Astral, Avanti Feeds, Bajaj Finance. These were always market leaders. We've bought newer market leaders like Ethos. We've bought in our portfolio. These are market leaders which are growing at 30%. Today, a food delivery company came out with numbers. The numbers are excellent just now. So you have to be with leaders who are growing at 30-40%. That is where, see, we are in a decade of wealth creation. And this year, if you waste your time buying 3-4% growth companies, then you've wasted your decade. Sumit ji has a strategy which says India's decade. This is India's decade and we want to make it very large. This is not about being, and our portfolio betas, you have to control it. So this is an opportunity to make it very, very large. And if we don't make it large in next 1 decade, it's our problem. It's our fault.
Absolutely.
Yes.
Absolutely.
So that is what we do on proven monopolies and emerging monopolies.
I just say it's not only decade, it's much more than that. I'm saying it's not only decade, it is much more than that.
Exactly.
That's an evolving story there. You know, India, the shining star. That's the header that we usually put. I mean, we get to see on the newspapers there. Gaurav, let me come to you in terms of the long short fund that you recently launched. So is that something which is going to become a mainstream product for the HNIs in the coming?
Right. So interesting question, Kshitij, because in India there is no definition to what a long short fund is supposed to mean in terms of risk and return, because you have an entire spectrum. There are long short funds that are running as quasi debt kind of strategies, and then there are long short funds that are running as more or less equity like strategies, right? But I think one thing that we know, and this is based on past empirical evidence, is the fact that usually whenever cost of money increases, so does volatility.
Right.
If you go back and look at the 2000 to 2010 period, yes, we all now in hindsight know that that was amongst the best period for Indian equities. Very good earnings growth, very good Sensex returns. But if you go back in that time, you will remember that volatility used to be very high, right? There used to be one down circuit almost every year, and episodes of 20-30% decline in stock prices in a matter of a week or two used to be much more frequent. The reason for that was that cost of money was high then. I think last 10 years, 2010 to 2020, we've all gotten used to very low volatility, and that's because interest rates globally were close to zero. But I think if there's something that's very evident now over the last 2-3 years is the fact that not only have rates risen, they are probably going to stay higher for longer, right? And in that context, you should expect volatility to pick up. And as that happens, I think people will need, again, I don't want to sort of take away from the fact that India is a very excellent growth story, right?
Right.
So on an end-on-end basis, you're going to make very good returns from Indian equities. But if volatility increases, you need products that allow you to stay invested through that high volatility period. And which is where I think some of these long-short funds become very important. The way we run our long-short fund is that, it's an equity biased product. We, at any point in time, are at least 70% invested. So the average equity allocation is 70%. But through the use of derivatives, we can move down to 0 also, and we can move up to 130 also.
Okay.
And this move from 0 to 130 is based on our own proprietary asset allocation frameworks, not on the subjectivity of any individual. And the idea here is that on an end-on-end basis, you should generate equity returns.
Right.
But when there are big drops in the market, let's say, Nifty fell by 40% during COVID, you should hopefully fall by 15, 16, 17%. Less than half of the indexes fall. If you can achieve that, then you will have a product that gives you that equity participation, but also gives you shock absorbers through the high volatility period. And to, very sort of answer your question in a very short manner after this long detour, yes, I think that as you move forward, as volatility picks up, long-short products will become a mainstay of investor portfolios.
Right. Well, great to know, and I'm sure investors would want to know more about the product. But while we are on this topic, in fact, you did touch upon the interest rates. I mean, over to you, Jigar. We were talking earlier about the interest rates and how it has moved from, let's say, 0, 1% to now 5%. We are talking about the US Treasuries. And you highlight a very important point that why central banks would want to, sort of keep inflation high, So if you can just elaborate on that part as well.
Yeah, it's sort of very controversial statement to make, but I don't think Fed is interested in bringing the inflation down.
Right.
So if I can bring in a little more context into this, right?
Sure.
So post 70s, when you disbanded the gold standard, we were in a bipolar world. There was the USSR and the United States of America. And once 1991 December, when the USSR flag was hoisted down for the final time at the Kremlin, you emerged into a unipolar world. That power eventually consolidated, and nothing corrupts absolutely like an absolute power. So it takes 8.6 cents for the US to make $100 bill.
Okay.
Right? And India has to create this chair to match that up. Until 2008, they were at $1 trillion at the Fed, the absolute size. And that in Jan 2022 reached to $9 trillion. So they kept on printing, and until the time the global savers were putting money in the United States as a reserve currency, it wasn't really hurting them as much. That sadly increased the US debt to GDP at around 131%, 142 at its peak. But think of this scenario now. Earlier, there was no alternative, right? Euro is a bank without a state. Japan has yield curve control. China, nobody really trusts. India has capital convertibility issues. So there was no alternative. Increasingly, we are moving to a multipolar world, where China is telling 15 of its partners, let's deal in yuan. We are telling 20 people, let's deal in the rupee. And they need to prepare for a lower debt to GDP number.
True.
And in that preparation, it's unlikely that they're going to crush the economy. So whereas we hear a lot about what Jerome Powell has said, we don't pay enough attention to what Treasury is doing. Right? You look at the Treasury General Account, you look at the reverse repo, they are acting against. From October, they increase the liquidity and so on. So I think what's going to happen is that we are going to have these shorter cycles of, euphoria like we have seen for the last couple of days in the market. And then, they want to keep the economy running, inflation high, interest rate at an elevated level, so that the debt to GDP could come down. So I think this is the thesis. If that plays out, then India's repo to the Fed fund target rate upper bound is at 100 basis point differential, right? We have never been there at 100 basis ever. 400 was during COVID when India was fragile. 2013, it was 800. So this brings the risks, right? We are very happy with the JP Morgan bond inclusion, but the oil price increase since then has taken away more than that. So at the BOP level, you're not really facing the issue. So I think all decisions that we end up making should take into account that rates are here to stay for an extended period. And that brings a lot of skeletons out of the closet.
Well, probably it might have some impact on RBI as well, now that we are discussing US Fed. But interesting point there, Jigar. Thank you so much for that. And I'm sure our investors will take note of this same as well. Now, Sumit, now that we are on the interest rates, the sector which gets impacted the most are financial services. And, from that aspect, especially in 2023, we've seen PSU sector, PSU banks sort of, getting the multi-bagger tag. So we've seen good 50 or 80% kind of a jump in a lot of PSU banks. And and obviously a little bit of movement in the NBFCs as well. So from that perspective, how is financial services sector placed at this point in time? Do you believe in the euphoria that we are already seeing? And as you said that it's going to be India's decade, banks would be, I'm sure, the front-running contenders to be part of that cycle.
When we think about financial services sector, lending is one of the opportunity. There are multiple opportunities beyond lending. I'll come to lending in a while, but there are opportunities with respect to market infrastructure businesses.
Okay.
There are exchanges. There are rating agencies. There are insurances as well. So those were, some of those opportunities were not there in the past. So today, purely from a financial services perspective, the opportunity has kind of increased multifold. And I'm pretty confident that over next few years, number of businesses within this area will only increase. Coming to your point specifically on lending businesses and between banks and NBFCs, see, banks had a dream run. Last year was a year where the 𝒕𝒂𝒏 thing, whether it is their overall AUM growth or whether it is NIMs, whether it is provisions, ROE, everything was pretty decent, right? Now with cost of deposit also starting to catch up, we may start to see their NIMs getting impacted. That same thing may not be true for NBFC kind of businesses, right? They have taken some hit already onto their balance sheet, right, onto their P&L. So from here on, those NBFCs which actually have ability to cross-sell, who understands their customer really well, and technology has started to play a significantly bigger role. Data analytics within banks is also, or within many of these lending institutions, is starting to play a significantly bigger role. So those who can use those in a significantly better manner would actually be value creator of future actually. So I'll not club them between banks, NBFCs. Right? Over period, you need to kind of deliver onto the 𝒕𝒂𝒏 of lending growth with gross NPA management and ROE.
So in terms of any key parameters that you've been watching in that space, if someone wants to make a connect, is this something which specifically in terms of banking or financial services, what should investors track?
So clearly they should focus on how, see, banking is a business or lending is a business where you may lend once, but there is a huge amount of friction that is involved. Right? So lending is easy, but getting that money back is something that you need to focus significantly more on. And that is where the differences lie between one organization and another. And so to that extent, how well an institution can control their gross NPA with a very mindful eye on ROE and growth. And those are the parameters that we'll keep focusing on.
Right. Now, Amit, now that you're here and you do talk about companies, so I'll put some question around it that we've seen a lot of stories floating on the new age companies. Recently, there's an IPO that was opened, and especially when markets touch record high, we see flurry of companies wanting to raise money. So, do you also get attracted to these opportunities as probably the stories are floated across, or how do you make that kind of judgment?
See, I mean, there was a time, Kshitij, see, the market moves from extreme bull. There was a time where the markets were ready to pay $20–30 billion for Paytm. And there was a time when everyone wanted to bid Paytm. And there was a time that $4 billion there was no buyer, okay, with $1.2 billion of cash on books. Right. So market keeps moving, the market keeps giving you opportunities. I'll give you an example of QSR sector, okay, just giving you an example.
Sure.
It might have vested interest, of course, we have vested interest. But in QSR, if someone looks at Devyani, Sapphire, Westlife, they typically trade at 80, 100, 120 PE multiple.
Right.
Typically, all of them. Jubilant, which there's very weak growth for last 6–7 quarters, also traded at 70, 75 PE multiple. Today, Zomato is at 7.5. Last quarter was 7,500 crores GMV. This quarter, there's a quarter-over-quarter growth of 13%. I've not seen the numbers properly because since I'm here, I'm not able to see numbers properly. But probably 8,300–400 would be Zomato's GMV this quarter. Zomato will end this year at 32,000 crores of GMV. Kitna mal bechta hai? Last quarter, EBITDA, which is your PBT type number, was 3%. If Zomato does 32,000 crores, this year probably will grow at 30% next year. We'll do 40,000 crores of GMV. Assuming it does at 4% or 5% adjusted EBITDA kind of number. You're looking at 1,600 crores to 2,000 crores of PAT type of number. Minimum that will be the PAT for Zomato. If that is your PAT, we bought Zomato at let's say 70,000 crores. So we were buying Zomato, which is a superior franchisee to Westlife, Devyani, Sapphire. This quarter, Westlife growth was 7%. Devyani, Sapphire was decent at 16%. Jubilant was 5%. You're buying a company which is growing 4 or 5 times higher than them at lower P, at 1/3 the P of them, is a hyperscale model pivoting to newer places. Management, after 20 years, Westlife has not been able to make 100 crores of PAT. After Westlife, McDonald's started in 1996 in India. After 27 years, McDonald's has not made 100 crores of PAT. And see, if today it makes 2,000 crores of PAT this next year, you automatically come into the large cap space.
Yes.
Because you'll get anywhere between 50, 100. I don't know what P the market gives. I know the downside P. Same is with Paytm also. Now these stories can go wrong also and we can cut out also. I'll just give you an example of Paytm. 4 years back, 5 years back, UPI was unknown. Now we do 16 lakh crores of UPI a month. Today, Paytm has started lending 2 years back. Paytm is doing 5,400 crores of lending a month. And this can be just day zero in Paytm. How do we know it can't be 2 lakh crore, 4 lakh crore, 5 lakh crore? India's disbursement market is 180 lakh crores a year. So, and why should a shopkeeper go stand outside the bank, take a loan, button dabaya, paisa aaya, button dabaya, paisa wapas gaya?
Right.
that boss, galla kaun chhodta hai? For me, galla is this, I'm not able to leave this. So,
no, absolutely. Things are changing.
If things are changing, today we have 1,000 crores of adjusted profit, Paytm will do this year. Next year, it is expected, analyst, if 1,000 crores is adjusted profit, ESOP के कारण 1,700 crore का ESOP cost है, तो आपको वो ESOP is a non-cash cost, यार. You have to value companies on free cash flow. So we got a full toss ball, we hit sixers. So we got a full toss in Paytm. PB Fintech was also that. India's total yearly, our total GDP is $3 trillion. $3 trillion into 80 is 240 lakh crores. That is our total GDP. 20% is our savings rate. 48 lakh crores is our savings every year. Every year we save 48 lakh crores. On that 48 lakh crores, we invest 9 lakh crores in insurance. 7 lakh crore goes towards general life insurance. 2 lakh crore goes towards general insurance. 13 lakh crores goes towards FD every year. 4 lakh crores, 4.5 lakh crores of gold we buy every year. 5 lakh crores goes towards real estate, etc. 2 lakh crores, 16,000 crore एक महीने का mutual fund में आ रहा है. That is 2 lakh crores goes towards mutual funds every year. And some money is unaccounted. That's okay, but that is how India spends. Policy Bazaar is 1% of India's entire insurance market. That insurance market is expected to double from 9 lakh crores now to 18 lakh crores in next 5 years. If that insurance doubles, now the question you have to ask is, ये आज 12,000 crore का Policy Bazaar is 1.3% of the entire market, yet a monopoly. You have to see that if Policy Bazaar is that 1.3% and the market is doubling, can Policy Bazaar become 3-4% market share? In technology, the cost remains same. आप 10,000 policies लो या 10 lakh policy लो, cost में कोई ज़्यादा change नहीं होता है. It's a J curve that will happen. Now they have guided for 1,000 crores PAT. I think the 850 crores will come next year. So let's see if we can go wrong also. We are great managers of risk. It is not about going right or wrong. If we go wrong, how much money we lose, and if we go right, how big we make it. So yeah, that's what we try to do.
Interesting statistics there, Amit. As usual, I'm sure our audience will take time to really digest and take note of. But yes, I'm sure they will. But in the meantime, Gaurav, let me also put some focus on the ESG filters that you sort of adopt whenever you're making the investment choices.
Right. So, first of all, I think we were amongst the first fund houses on the mutual fund side to come with an ESG fund. And now, on the PMS side also, we were, I think, amongst the first ones to come with a PMS strategy on ESG as well.
Right.
And, I think ESG to a lot of people sounds like a very, boring theme, right? Environmental, social governance, kya hai usme? But, again, different people approach ESG very differently, right? For a lot of people, ESG investing is buying green energy, buying hydrogen, buying electrification and so on. For us, ESG is not that. For us, ESG investing is about buying all sectors that you potentially can, but eliminating companies that are following unsustainable ESG practices. And the way we do that is, we have an in-house ESG team that has its own ESG frameworks. And we also have, external agencies like MSCI and CRISIL give us ESG scores. But for us, the idea is that we are open to investing in chemicals. But there is a chemical company that's throwing all the hazardous waste and polluting the environment versus another company that's following the right effluent treatment. We want to differentiate between those two. There is a chemical company that's following the right employee safety, practices, and as a result, employee safety is assured. While there are companies where employees, work in hazardous conditions, there are fire incidents and so on. All we are saying is that if you are not, treating your affluent, if you're not treating your employees, you're not worrying for employee safety, sooner or later that business is going to be shut, either by regulation, by labor, or for whatever reasons, right? And then, thinking about EPS growth for the next 2 years, 3 years, and then looking at PE and investing in those companies makes no sense, because there'll be an abrupt stop and you'll never be able to figure that out in advance. So for us, ESG is just putting that layer of sustainability. Will this business continue compounding for the next several years because it's environmentally conscious, it's socially aware, and most importantly, it's following the right governance practices. And again, mind you, for us, the charm of alternatives investing is that you can invest in a large spectrum of stocks that you can otherwise not invest in on conventional mutual funds, because sizes that are there have become draconian. So your investment universe is shrinking to the top 200, 300 liquid names there, right? So the rest of the universe you can exploit through the alternatives platform. But when you're investing in small caps or smaller companies, the chances of accidents are even higher, right? You might, obviously the chances of fetching multi-baggers there is also high, but chances of losing your shirt is also very high with small caps. So for us, if you put a layer of sustainability on top of this sort of multi-cap investing, then I think you can potentially aspire to find the right growth opportunities while also minimizing accidents to the extent possible. So that's how we think of integrating sustainability into overall businesses and overall investing.
Right. Nicely put there, Gaurav. Now, Jigar, in fact, Gaurav did highlight about the changing market conditions as well. So, we've seen external factors impacting Indian market. We've seen domestic factors in Indian markets. How agile one has to be to adjust to these changing themes that impacts market. Although we have a discipline, I'm sure every fund manager has this discipline that they follow. and probably it might have, let's say, 10 checklist items. But from that 10, maybe 4 or 5 are working, and probably the other are not relevant at this point in time. So how do you sort of make that conscious call as to how to adjust the portfolio?
Right, Kshitij. So I think one has to be sort of fairly agile into how you manage your risk, because things that have never happened before are happening all the time now.
Absolutely.
Right? Markets had never fallen more than 30% in a single month before March 2020.
Right.
The 60-40, the famous US portfolio, had never fallen in double digit, both debt and equity, in 1 year until it did in 2022. So, any algorithmic mindset that you might approach it with, saying, okay, this is the formula and this is how I'll approach it, is unlikely to work because things are changing all the time now. The other thing one needs to decide is whether volatility for them is risk or not. Right? For a lot of people, volatility is not risk. Right? If you know a value of 100 rupees is eventually going to 300, then you don't care if it goes to 50 before. Right? If you are one of them, then I think, choosing a reasonably decent company at a valuation that makes sense does work in a lot.
Right.
But the way markets are operating, especially, like we were discussing this, that between April and September, there are 120 companies that have gone up between 70 and 100%. And there are 140 companies that have more than doubled in under 6 months. Right? 85 and 87% of those companies respectively were small caps. Now you have seen the period between, I was mentioning Jan 18 and March 20.
Right.
The index was down 50. The best run funds were down 70. If you're one of those who can live with a 70% market correction and then still continue to believe that your philosophy works, then you are among the minority. If you are not, then I think protecting capital is very important. And the other thing with a lot of small caps is that you can only sell them in a great market, right?
The liquidity is,
liquidity is absolutely absent. The moment market takes a U-turn, liquidity dries out. So I think at least the way we are running it is changing the stance to defensive, where the idea is to protect the capital on the downside. The portfolio composition changes,
right.
And then the market is, when the market gets very, very upset about something or the other, that's when we dial the risk up. You can measure it with beta, etc., but statistical measures beyond a point don't really tell you what you need to know if you were to liquidate your portfolio.
Absolutely. Interesting point. And I'm sure I'll probably, just very quickly, because we're running out of time as well, but the right point to do or the right strategy would be identifying, is this the time to, add on, or is it the time to protect your capital? Is that the decision or the key decision that one has to make? And this is relevant for investors as well who've been investing the money.
Correct. So I think, if you keep tracking just one parameter, earnings per share or PE, that doesn't really tell you a lot of the statistics.
Right.
So you approach it from a holistic perspective. You do a reverse DCF and say, look, if you're buying the whole business at X, what is the market forcing you to assume?
Yeah.
If that, as an analyst, you having covered it for an extended period of time, if that makes sense, then you keep on owning it. Because otherwise, PE is a state of mind.
Right.
There are times when people are happy with 100 PE. There are times when 10 is too much.
True. Now, Sumit, let me come to you. And ASK is one of the oldest funds that we have, and you've been able to generate alpha consistently. So, quickly highlight the defining factors for the same.
Many times, discussion happen on what the macro environment is. Where will GDP growth rates go to? Where will inflation go to? Where will interest rate go to? Right? And those do have impact on market from a relatively shorter period of time. But over longer term, what matters is how is the underlying business that you have invested into have been performing. Right? There have been very stale businesses in the marketplace, which have been very great value creators as well. Right? Think about a company by the name Pidilite. 10 years back, this was 115 the price what it is at. That company kept on delivering onto the earnings compounding with capital efficiency which has been only increasing, right? And that sheer compounding of earnings with capital efficiency, irrespective of the how shorter term macro has actually played out, has led to that significantly higher value creation in that name. So macros will remain volatile. Our whole idea is to how we keep improvising our portfolio, how we buy into businesses which have this strength to really tide on to the external macro vagaries. Also, it's vital that the businesses that you are getting into, do they have significantly larger opportunity size so that they can keep growing on for a length of time. And opportunity size along with the execution capability of the management wherein they have capability to increase their market share across varied business environment. This combination will allow you to kind of deliver relatively better returns across business cycles. Cycles will keep coming up and our ability to really project as to this is the way market cycles and economic cycles will play out is always going to be challenged.
Rightly put there. Now, yes, we are running out of time. So very quickly, we are approaching the festive season. We are approaching Diwali. I am from media and I have to ask one question. That is, market kya lagta hai in 2080? So yes, this is the most prominent question which, at least I will ask because I'm sure a lot of our investors would want to know about the same as well. So starting with you, Amit, कैसा लगता है बाकी 2080 संवत में?
See, I don't know about 2024 is very long for us, but right now it looks like a bull market correction to me. So if the 2-year Nifty 500 returns are near 0%.
Right.
See, we don't, like for us, we're not like small cap investors. So for us, it's more Nifty 500 is a better benchmark.
Right.
But I would say that last 2 years have not been so good for markets. It's been good, decent for us.
Right.
But for the markets in general, it's been very mediocre. The next 2-3 years, hopefully, if we've got some events which are coming, a political event, this, that.
Absolutely, that would be fine. Yeah.
But yeah, even if 𝒉𝒂𝒂𝒏 comes, if you're good enough, you'll make money. So,
that's a very optimistic statement coming in from Amit, I guess. Huh?
So, there are opportunities. We'll have to work harder. But I don't find any reasons why next 3-4 years will not be very good for markets, us. And if you're decent at stock picking, good things will happen.
Right. So Amit says bull market correction. Gaurav, what about you?
So I mean, to answer this question on market kya lagta hai, we have actually created an asset allocation framework. Okay. Looks at 3 simple things: earnings, valuations, and market sentiment.
Right.
Now, as we stand, and again, valuations for us is PE with respect to where bond yields are. So at 7.3 or wherever the 10-year bond yield in India is,
right.
22 PE is slightly expensive. Right? I'm talking about trailing PE because we only talk about trailing numbers,
absolutely,
right?
Yeah.
On market sentiment, we are a little heated, and which is usually not a good sign from a forward returns point of view. But the third factor, which is earnings, is extremely positive.
True.
Because profits to GDP is what we use to track earnings. After 12 years of decline on that profitability, it's only last 2-3 years that you have started revising up. Okay. Right? So to that extent, it gives you hope that you're in early stages of an earnings expansion cycle. Right. So now if I combine all of this, it will depend on your investment time frame. If you're thinking of 12 months, then I won't be surprised if the consolidation that we've seen over the last 2 years continues. I think October of 21, Nifty was at 18,600.
Right.
Today Nifty is at 19 something. Right? So 2 years of nothing, but a lot of earnings catch up, so PEs have come down. So I won't be surprised if that continues for the next few quarters as well. Right. But if you are a 3-year investor with a 3-year plus time frame, then that earnings story is very strong, and that earnings expansion cycle should mean that you should still be generating decent returns from equities.
Right.
So I think that's how I will want to calibrate it.
So Gaurav says earnings story will remain relatively strong. Jigar, very quickly to you because...
A great place to be for 10 years.
Great place to be for 10 years.
The run-up to that 10 years might not be as rosy. So
okay, fine. Sumit, your last word on that?
So see, unless we see some impact globally, right, whether it is impact of the existing geopolitical pressures that we are seeing, or probably some after effect of the sharp interest rates that world has seen, right? Otherwise, don't see too much of a reason to be negative on markets.
Right.
Having said that, if last year was a year where index in general has done phenomenally well, whether it is small cap or mid cap, I think this is going to be more businesses which will be very different, or businesses which are really performing. Right. So you will actually differentiate in terms of what gives returns and what does not.
Right. Well, on that promising note, thank you so much for your time, gentlemen. It was a fabulous, insightful, and a strong discussion. Thank you so much for your time, guys. Thank you so much. You've been a lovely audience.